So sectors, a bit of a mixed bag this morning. Let's check in with Bob Pisani. Hey, Bob.
That's exactly right, Carl. Mixed bag. It's a flattish open, defensive tilt somewhat. Still uncertain about where this is going to go today. Let's look at the sectors. So we started defensively. Utilities, consumer staples, healthcare was outperforming. More flattish now, but what's key here is energy, once again underperforming, and of course the banks here. Been talking about the bank earnings all day here. Wells Fargo down about 6%. It's a very simple story here about this. Larger provisions for loan losses. These are very, very hard to estimate. Wells Fargo had a loss of 66 cents. The analyst estimate was a loss of 20 cents. That's a huge dispersion. This is what I've been talking about. They can't get their hands around these problems. In this particular case, loan losses. The big money center banks have a big advantage because they have trading operations, the JP Morgans and the Citigroups. We've said this over and over, but let me just show you the revenues, for example, that JP Morgan gets right now. They have a substantial consumer division. They get about almost half of their revenues from consumer lending, and they have a substantial wealth advice business. They also have commercial business out there. But you see that corporate investment, 32%? Well, that's investment banking and trading. That's what the big regional banks, the Wells Fargo, the PNCs, Fifth Thirds, they don't have that. And when you have a very profitable quarter in investments, that helps balance some of those other issues like loan loss provisions that are out there. Look at Wells Fargo, though. Wells Fargo makes money the old-fashioned way. There's basically three operations here. They lend to consumers and have a substantial one, like JP Morgan. They lend to commercial, like JP Morgan. And they have a substantial wealth advice business, which is pretty substantial. And these banks are trying to grow that wealth advice business. But you notice they don't have a trading operation. And that's a problem. So the analysts were wrong in estimating the amount of loan loss provisions. And I think this is going to be an issue for a lot of the regional banks going forward that don't have these trading operations that they can add into their revenues. Just keep an eye on that. And of course, regional banks have been acting terribly recently because the market is well aware of that. So where are we right now in the overall market? I keep talking, make it simple. Think in terms of these 5 buckets of what moves the markets here. So the reopening story is the most important thing. And maybe the reopening story is becoming a reclosing story. That's what we don't know of. A lot of companies are not as forthcoming, I think, in the next few weeks because we don't have a clear idea of how the reopening is going. Stimulus, yeah, it's there, but you just see McConnell, he's talking about maybe one more package, maybe less intense stimulus coming. That's not overall positive. Valuation, look, there's a lot of profits hiding in tech. You saw what happened yesterday. Tech's up 10% in 2 weeks. They'll take profits very quickly if they think there's a short-term pullback. The momentum guys are not what you call strong hand players. What about other things out there? How about what's going on with the trade war? Well, we've seen intensifying conflicts with China. I don't think there's a lot of positive there, not just sanctions, other things going on there. So treatment is the one absolute positive. Treatment and vaccine hopes, the one absolute positive that is still sitting out there. The other 4 are still, kind of iffy right now. That's one of the reasons the market's been fluttering around here. How about what fund managers think? Every month we talk about this. Merrill Lynch, they survey 150 or so global fund managers. We watch it for a sign of what the big dealers, what the big money managers are looking for here. The most crowded trade, go long tech. 74% said that was the most crowded trade, and that is the highest in history they've ever had. That's a long trade right there. Those expecting a V recovery, only 14%. That's pretty low now. That number is dropping. The greatest risk to the rally is, of course, the second wave of coronavirus concerns that are out there. And the biggest game changer is a vaccine. Everyone agrees there. That would completely flip those numbers around about the risk to the rally and the V-shaped recovery.